Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So throughout 2022, we have seen really a collapse of the bond market. These are bond prices that have broken down below their secular uptrend that really began in the 1980s. We had a steady secular uptrend for almost 40 years that has now come to an end. Now, this isn't the first time in history that we've seen this happen. Of course, it happened in the 1960s right here, right at the beginning of the great stagflation of the 1970s that eventually led to 15% year-on-year inflation rate. But what few people are aware of is that this also happened during the Great Depression here in 1931 as the financial system was collapsing, millions were unemployed. Treasury bond prices actually dropped in a similar fashion to what we've seen today, and also even to a greater extent in the early 1920s, where we saw a massive decline in the 10-year Treasury bond price. In fact, the 1920 collapse of the bond market has a ridiculous number of similarities to today's market, and it actually led to the single worst deflationary events that we've seen over the last 100 years, a severe financial crisis and a drop in the stock market similar in magnitude to what we saw in 2008. Now, while all of these episodes played out in different ways, they did all have a single common factor, and that was a destabilization of the financial system and an ominous sign for the financial markets and the economy. So we're going to be looking at these episodes today and trying to understand and, more importantly, answer the question, which of these breakdowns is the most similar to what we've seen in 2022. If you enjoy these types of higher effort videos that really dig into all of these episodes to try and put as much perspective and historical context around what is happening today, well, let us know by hitting that gray thumb. And now, without further ado, let's get right into it. So the first episode I want to focus on is the 1960s right here. But before I do so, let's take a look at bond yields instead of bond prices. Now, this is a chart that shows the inverse of the 10-year yield, and that basically shows you what the price of the 10-year Treasury bond has done over the past 100 years. But to understand the relationships with inflation and the Fed to a greater extent, we can take a look at the 10-year yield. Now, this breakout in yields that you could argue, again, is similar to the breakout in yields that we've seen in 2022, really came after a big inflation surge right here towards the end of the 1950s. Now, this came after an extended period of very easy monetary policy where rates were pretty much capped during the duration of the Second World War. And that was then followed, here you can see on this chart right there, by a gradual increase in government spending during the 1950s and 1960s that caused this inflation breakout in the first place and eventually led to the inflationary 70s that created a massive amount of volatility in the markets. What's interesting and peculiar about this episode is that the stock market back then, if we add the SP500, it didn't actually care about this rise in bond yields. Bond yields went from around 2%, you can see there on the right, all the way to 4.7% quite rapidly. And yet the stock market throughout this entire period kept on moving higher. Now, if I add the unemployment rate on this chart here in orange, you can see this entire period here in the 1950s, we had this beautiful balance between the unemployment rate that was moving higher as rates were moving lower. Then as the unemployment rate went down, the economy was booming, rates were moving higher. Then again, during a recession in 1958, you can see unemployment skyrocketing, but yields are coming down to counterbalance that. And you can see again in 1960, unemployment rate moving higher. Yes, there's a recession here, but rates are moving lower. And during this entire period, you can see that provided a certain amount of stability to the stock market that kept it trending higher and higher and higher all the way to 1968. Now, of course, arguably in 1957, we were starting out with much cheaper valuations. And you can see that on this chart right here of the Dow to GDP ratio, another great chart that shows you market valuations over time. And you can see during the 1950s, stocks weren't expensive, they weren't cheap, but they definitely still had room to run. And arguably today, our starting point in terms of valuations is a lot higher than it was in the 1950s, which gives us a lot less room for them to continue expanding like they did leading up to 1968, which essentially fueled this entire secular bull run between 1953 and 1968, despite the fact that you had big volatility in rates and big volatility in the labor market. So there are some links to be made between today and the late 50s and early 60s, because we were coming out of a period where rates were incredibly low. You had this first inflation breakout that caused this breakout in interest rates, and you also had a lot of government spending, which has definitely been the case between 2020 and today. Now let's go back further in history and take a look at 1932. Now the first time I saw this spike here in 1931, I really couldn't understand why it happened. And this is why I wanted to include this episode in this video, because this spike here, you can see right here, this spike occurred when inflation was at negative 10%. This was a deflationary environment. Now you can see throughout the 1960s, 1970s, we had rates rise with inflation. In 2022, we have rates rising with inflation as the Fed is tightening monetary policy, raising rates in order to fight inflation. In 1932, we had deflation. So why were rates rising right there? What was the Fed trying to do right here, especially when the unemployment rate was rising incredibly quickly, crossing 15% as the Fed was tightening monetary policy? It's the completely opposite scenario to what we have today. You can see here unemployment rate is incredibly low. We haven't seen unemployment rate rise, and we have high inflation. In 1932, we had the unemployment rate that was rising and we had deflation. So what happened? This is clear evidence of one of the worst monetary policy mistakes in history, which prolonged the depression for much longer than what it should have lasted for. They tightened monetary policy during an ongoing financial crisis. So this is not at all what's going on today. Now, could it turn into that? Could this scenario happen again? Anything is possible, but this does show you that the Federal Reserve has a complete and absolute monopoly on the credit system, that even during the worst downturns in financial history, they have the power, whether that is intentional or not, to keep the depression going for longer. By the way, quick reminder, if you're so far enjoying the video, make sure to hit that like button to let us know if you're appreciating the value that you're getting out of these videos. It is really appreciated. Now let's take a look at the 1920s, because I think this is really the most fascinating episode because of the sheer number of similarities that we have to today, including the fact that this was a very rapid rise in interest rates that you could argue looks similar to today, especially if we do see a rapid reversal of this move, which we're going to talk about in just a second. First of all, this episode occurred right after the Spanish flu pandemic. So from a consumer and market behavior standpoint, we can already draw some links between today and the 1920 episode. Now, what's also interesting is that between 1918 and 1920, we had inflation. You can see this is the year-on-year inflation rate that was running out of control during the First World War and the beginning of the Spanish flu pandemic. And you can see despite that, the Fed had kept rates very low, despite the fact that inflation was running out of control throughout those years, with inflation reaching a staggering 20%. You can see there on the right hand side of the chart. Now, if that sounds pretty familiar, well, you'd be absolutely right, because if you remember in 2021, inflation was clearly breaking out and moving towards 6, 7, even 8% before the Fed decided to raise its interest rate in March of 2022. But the similarities don't stop there, because the Fed then decided very late to raise rates very aggressively, causing a breakdown in the bond market and a very rapid tightening of financial conditions that you could argue, again, looks similar to today, right as inflation was actually coming down and the unemployment rate was moving higher. You can see here, this is the unemployment rate for the UK. I couldn't find a clean chart for the unemployment rate of the United States, but in general, throughout history, they've tracked each other very closely. And you can see in 1919, the unemployment rate was rising and the Fed continued to raise rates well into 1920. So as as I said at the beginning of the video, this eventually caused the worst deflationary episodes over the last 100 years and a stock market drop of around 45%. So the 1920 episode definitely has quite a few very interesting similarities in the sense that we were coming out of a pandemic. We had inflation that had run out of control and the Fed had not done anything to control it. And when it eventually did step in to control inflation, it did so in a very, very aggressive manner, just like we've seen this year. The big difference to me, and again, the truth of the matter is that we don't have much data on this episode going back to the 1920s, but from what I've seen, we had clear signs that the unemployment rate was already moving higher in 1919 and the Fed continued to tighten into 1920. Today, we do not have evidence of a jump in unemployment, and it could very well be the case that by the time we do see a jump in the unemployment rate, the Fed is already beginning to ease monetary policy and inflation has already come down significantly, which would provide a dynamic that looks a lot more similar to what we saw between 1950 and 1960, where you did see wild swings in unemployment, you did see wild swings in interest rates, but they counterbalanced each other pretty well. So I hope you learned something new in this video. If you want to find out how we're currently positioning for the opportunities and risks that we see in the market today, you can check out gameoftrades.net. All of the pieces that we post are designed to help you get very quick updates on the market, whether that is from important developments on the macro or the price action, highlighting the entries, the targets that we have on the key trade that we have on the website. Now, in the meantime, I wish you good luck on your trading and see you next time.